Good afternoon, everybody, and welcome to our live webinar to discuss the implications of the Debt Intervention Bill on the listed credit retailers. Just a couple of housekeeping things. There are slides available for you to download. I will also be showing them on the screen so that you can follow as we go. And if you have any questions, please pop them into the chat box. I will be stopping from time to time to review the questions and answer them. If there are any questions I cannot answer, I will research the answer and email to everybody who attended this webinar today. So before we start, there are a couple of interesting things to note about this debt intervention bill. The first is that it was not developed and formulated by the Department of Trade and Industry itself, but rather by the members of the Parliamentary Committee. And as such, it does reflect some biases and agendas of those members. And you can see it coming through in some of the aspects. The second element is that we do not yet have a start date. So there is some uncertainty as to when this will all come. And of course, there's also an issue around if. Some people have indicated that they will look to challenge the bill on various grounds. But I think the most important thing is that we need to think about this bill as an amendment to the National Credit Act. It is an extension of our journey that began with the NCA when it was implemented in June 2007. A lot of what we have seen come through in this bill is not new. It is merely an extension of existing precedents already in the NCA. This presentation is going to take part in four places, in four parts. The first we'll just look at how this amendment bill changes the existing NCA. Then we'll move on to looking at what some of the consequences for these changes will be, and particularly with reference to the retailers. Then we're going to take a quick step back and just look at the overall state of the consumer in South Africa from a credit perspective, and then think through how the debt intervention bill might change this. And then lastly, we'll look at the implications for the individual listed retailers and finish with a summary of who we think is best positioned and more defensive, and who will be most impacted by these changes. So just starting off with the existing NCA as it stands right now, and then what the debt intervention bill will add. It's very important to note that right now as we sit here, if a consumer is over indebted and needs to escape from a debt trap, that there are various legal processes available to do that, using the sequestration, insolvency, and debt administration processes. One of the things that comes through very clearly in the document is that some of the committee members, at least, obviously felt very passionately that this was a quite unequal and unfair situation because these processes cost money. And for poorer consumers, there was no legal way for them to escape a debt trap. There is not, this debt intervention bill does not, despite some of the media coverage that we've seen, it does not promise consumers that there will be a magic wand that will make their debt go away. That is not contemplated at all. What it does is it introduces a process to enable consumers either to manage down their debt themselves by rescheduling and reducing interest rates. If at the end of 2 years, the consumer is still in a debt trap, at that point, debt could be extinguished. There is, of course, one exception to this, and that is if there is a case of reckless lending. The existing NCA already makes a situation where if a consumer can prove that the credit provider extended credit recklessly, that debt can be written off and forgiven. So this isn't a new thing at all. It is extending what we already have in the existing NCA. Right, the NCA process as it works right now in terms of relieving over indebtedness is really centered around the debt counseling process. And just to give you a sense of what that debt counseling process does, the debt counselors at the moment work in the private sector. They are not part of the National Credit Regulator at all, but they are regulated by the regulator and have to be registered with the regulator. They do charge fees for their services, and as I mentioned earlier, if a credit provider can be proved to have lent recklessly, then that debt will be written off and forgiven. The debt counselor's job is really to review a portfolio of a consumer's debt and to make recommendations around how it can be restructured to make it more affordable for the consumer to service that debt. So what we can do practically is we can rearrange the terms of the debt, can either lengthen the term of the debt or decrease the interest rate. There's also the possibility of putting in a debt consolidation package. But typically what will happen is that the debt counselor will do a combination of both things. So we'll see a lengthening of the term of the debt, and then there is a provision in the Act already that you can have the interest rate lowered to the lowest level of the debts that that consumer has. So typically that would be for a mortgage rate, for example. So you would have then a situation where, say, a credit card interest rate comes down to the level of a mortgage rate. As far as the credit bureau are concerned, the debt counselling process is flagged there, and once the consumer has exited debt counselling, then that flag will be removed, and to show that the process is complete. Comparing this to the debt intervention bill, it extends the debt counselling framework with oversight by the regulator and particularly by the National Consumer Tribunal. The process, instead of being run by the independent debt counsellors, is run through the tribunal particularly, and also with help from the regulator. And these debt counsellors then work within the tribunal. There are no fees paid by the consumer for this service. And in comparison to the debt counselling, where a debt counsellor only assesses if a loan was granted recklessly if the consumer requests it, there is now a requirement that all loans will be assessed for reckless lending. Then the process plays out by the NCT rearranging the terms of the debt. That can be through lengthening the term, through adjusting the interest rates downwards, and there is now a new and special provision that means that interest rates can be adjusted down to zero. In other words, that a credit provider who has a customer that is in debt intervention can expect the return of the capital over a longer time period with no interest on that. And then the debt intervention process is also going to be noted at the Bureau, and once the customer has exited that process through repaying the debt, then a clearance certificate will be issued, and they can show that to the bureaus. Right, both the old NCA and the debt intervention bill mean that consumers that are in these processes will be prevented from accessing new credit while those processes are underway. There has been some criticism of this in the past. To be honest, it just seems like a perfectly sensible thing to do to make sure that somebody's in a debt trap cannot extend that further. The existing National Credit Act is enabled through the magistrates' courts. The new debt intervention bill will continue to use the magistrates' courts to make these plans legal, but the National Tribunal also has legal standing here. And then the last point of difference is really about the debts that can be collected here. At the moment, the NCA says that debts that are older than 3 years that have been prescribed can't be collected. Now, what does prescribing mean? It means that basically the consumer has not acknowledged any liability. In other words, they have made no payments and they have signed no acknowledgement of debt, and the provider as well has also not made any effort to collect the debt. The debt intervention bill is going to apply to debt that is less than 4 years old, so it can't be longer dated than that. But importantly, it doesn't just kick off last Tuesday. It will apply to any debt from here that is less than 4 years old. Right, now just talking through the debt intervention process, there are some good things that have come through here. The first is that the bill does introduce some compulsory credit life insurance in some credit agreements, so not across the board, but very specific circumstances. The second positive is that a customer in debt intervention is required to go through a financial literacy program, and this is really trying to prevent recurring instances of debt intervention for the same customer. It is trying to empower people to take control of their finances and to be able to manage debt as a financial tool. Right. The last good thing is that there are penalties for fraudulent use of the process by customers. So just to reiterate that this is not a free-for-all or a magic wand to make debt go away. In terms of how the process is going to work, we've, I think, all seen this, is that basically it is aimed at people who earn less than 7,500 Rand a month, with less than 50,000 Rand in unsecured debt, and who find themselves in an extremely indebted situation. The bill has not defined what extremely indebted means, and that is one of the things that still has to be clarified. The more important factor in this is not so much what the absolute limit is at the moment, but the fact that these limits are not set in stone and they can be changed at the minister's discretion without any consultation with any other party. As far as the compulsory credit life goes, there is a red flag there as well. The bill says that the cost to the consumer will be set down by the minister. Now, what isn't clear in reading the bill is whether this predates the implementation of the credit life premium caps that we experienced 2 years ago, or whether there is a possibility that we will see a further leg down in those credit premium caps, and that will then have a knock-on effect for profitability for insurers that have credit life products. The third red flag is that the minister can unilaterally apply for debt intervention processes to particular industries or in certain circumstances or in particular geographies. Now, the bill is quite passionate about seeing structural over-indebtedness as a problem in certain job categories, and it singles out particularly miners, factory workers, domestic workers, and farm workers. So to give you an example, it reads as if there is a possibility that if there were a strike, that the miners who had been in that strike, instead of having garnishee orders imposed on their salaries at a later date to repay that debt, could be put into a compulsory debt intervention process by the minister and have that debt extended and the interest rate lowered in order to address their indebtedness problem. All right, I'm going to quickly have a look at questions right now and see if there are any. Okay, there is one question which says, does the NCT have capacity to run this process? That is a good question. Both the regulator and the tribunal have been criticized for lack of efficiency historically. I think that the NCT is going to have to resource up. It's not clear that there is any budget for that. So it may be that implementation of this bill will have to wait until after next year's budgetary process. All right, let's move on to the potential consequences of the debt intervention bill. So one of the things that we've seen a lot of commentary in the press is this idea that there is this potential moral hazard if customers think that they can get a free pass, go on a big fat shopping trip, buy a lot, and then have the debt removed from having to repay that. I think we can fairly say that there is an endemic culture of non-payment in South Africa. We just have to look at the rates bills that are outstanding in the municipalities or the uncollected debts from Eskom. Also, a number of the retailers have said to me over the years that they find that payment patterns are better in the neighboring countries where they also offer credit than they are in South Africa themselves. There is also a risk, I suppose, that consumers may assume that the penalties for fraudulent use will not be applied to them, and we'll have to see how that plays out. The second potential consequence here is that it has made the legal protections for credit providers less certain, because the minister can change these rules of engagement without any consultation with the providers. So those monthly income cap and the limit on the value of the unsecured debt are up for change at the minister's discretion. And then, of course, there's also this idea about being able to apply debt interventions to industries or job categories or geographic areas at his discretion. It will mean that in some cases, credit providers find that they don't earn the interest rates that they are entitled to in terms of the current formula on a loan. This is not new. It is already the case where you have people going into debt counseling. And then the last element of uncertainty here around protections for credit providers is around the premium levels for credit life products. As I've already flagged to you, it's not clear whether there's a possibility that we will see these reduced further from here. The third potential impact is really an extension of what we've seen happen since the introduction of the NCA. And it looks as though this will increase the burden again on the credit providers to educate their customers in terms of their rights and responsibilities when they take out credit. There's a possibility that this will increase credit granting costs, and so squeeze margins because the interest rate that you charge is determined by a formula, and the fees are governed by the Act. and so could mean that we have a bias, at least in the short term, towards more conservative lending. And the irony of this is that both this bill and the NCA have as a stated aim to broaden access to credit markets for consumers. And then the last issue, which is where there's a possibility that this bill could be challenged, particularly in the Constitutional Court, is whether this is in fact a blow to property rights, insofar as a debtor's book is an asset owned by the retailer, and in some cases it is the biggest asset on the balance sheet. Right, the key risk in my view, though, is that there's been a lot of focus on the R7,500 level, but a lot of the bill really revolves around the idea that people can have a much higher level of income when they take out the debt, and there can be a change in their circumstance that means that they wind up having debt of less than R7,500. And the three things that are particularly talked about and mentioned, first of all, is retrenchment, and in these tough economic environment, that is not an unreasonable or unlikely event in some sectors. The second element that is flagged is the increased cost of living, and the last element is the death of a breadwinner, which I suppose is why they have factored in this compulsory credit life in some categories of debt. Right, I'm just going to pause and look for questions and see what else there is here. Question is there any restriction on the credit providers selling their books to debt collectors? The current Act does not have any restriction on that, and there doesn't seem to be any change to that in the current bill. So you would still be able to factor your book, as I understand it, and you certainly would be able to sell it to a debt collector. The debt collector, though, would have this, I guess, burden in terms of if the debt is more than 4 years old, then it could wind up in the process. There's another question that says, do these change in circumstances mean that the banks are at risk? I thought the Big Four only lent to wealthier consumers. The Big Four do generally tend to lend to wealthier consumers, although some of them they all have an element of an unsecured book. But what they are at risk for is the situation where somebody, for example, was retrenched and they didn't fall into the 7,500 and under category at the time of taking out the loan, but that has happened subsequent to them owning to the loan. All right, we're now going to move on to taking a look at the South African consumer debt market. Right, so as of March 2019, the total gross book outstanding of consumer debt in South Africa was just under 1.9 trillion rand, and just over half of that is in mortgages. The two categories that concern us here are credit facilities, which is about 13% of the total value of outstanding debt. That is mostly dominated by the bank's credit cards, but the store cards issued by the clothing retailers are also in there. And then the second category is the secured credit, which accounts for about 23% of the total book outstanding. Again, that is mainly dominated by the banks through vehicle finance, but the furniture retailers' secured credit loans also fall into that. And then the chart on the right-hand side just shows you really about appetite for credit. In a country with a population of 58 million, it is astounding that we continue to see quarterly applications for credit between 10 and 11 million. Now, a lot of this is people applying for credit and being turned down by one provider and then going back and applying at somebody else. But nonetheless, it seems a staggering number. So the appetite is still very strong and very healthy. What is less healthy has been the credit providers' willingness to lend since the NCA was introduced in June 2007. And at the moment, as you can see from that left-hand graph, we're actually back at the kind of levels that characterized the bursting of the bubble after we saw the boom in unsecured credit in 2011 and 2012. On the right-hand side, you can see there that the retailers' share in total number of accounts granted is around about 40%, but the value provided by them is only around 5%. So what we have here is a situation where we have lots of accounts of relatively small value. If we then zero in on the customers who earn less than 7,500 Rand a month, and this is just looking at the credit facilities, in other words, where the store cards are categorized. At the moment, we see that people who earn less than 7,500 Rand a month account for about 47% of the total account numbers in credit facilities, but only about 15% of the actual value. Right, I'm just going to look at the questions again and see if there are any more. Okay, so we do have a question here which says, what about the credit bureau information being wiped out? Now that is a good question, and it is a concern for anybody who provides credit. But again, this is not new. It is a situation that we have dealt with previously. So prior to the implementation of the NCA in 2007, there was a process of wiping all the data from all the adverse payment data from the credit bureaus, and the retailers and the banks had to be very cautious initially until some of that history had been rebuilt. But they also became more adept at developing quite sophisticated scorecards that look at behavioral and lifestyle elements to make a judgment about whether a customer is going to be a good payer or not. In 2014, we had a second amnesty. Now, that was not an amnesty in terms of having your debt reduced, but it was an amnesty in terms of having adverse payment history removed. So since the introduction of the NCA, basically, we've been through this process twice for everybody. So removing the payment data for individual customers who've been through a process is on a much smaller scale than we had before. All right, we're going to look now more closely at the actual retailers. So of the big listed retailers, there are 7 that provide credit. The clothing retailers obviously all do to a greater or lesser degree, remembering that Woolworths credit is in joint venture with ABSA in Woolworths Financial Services. They each own 50% of that. ABSA runs and manages the book and funds the book, and Woolworths obviously is the channel through which those products are sold. It's also, if you look in the middle column, the biggest book of the lot, and that reflects that there are store cards in there, but also, of course, the credit cards. Right, so if we just look at all the retailers, you can see that Truworths is the one that has the highest element of credit sales, credit accounting for 70% of sales. And this really talks to Truworths' philosophy about being a highly aspirational retailer, selling product to very aspirational middle-income customers that's very fashionable, very desirable, but relatively expensive, and squaring that affordability circle by offering the credit. Because of this ethos of credit being a sales enabler, Truworths doesn't look at its credit business as a standalone profit center, which the other retailers all do. Then as we go down the list, the one that's next most reliant on credit is Lewis. Following the UFO acquisition, that's now about 58% of sales, but within their historical brands, it's still about 2/3 of sales are on credit. And then it all falls off reasonably quickly. TFG, interestingly, now 43% of credit in the African business. 10 years ago, that was about 65%. And that management team has pursued deliberately a strategy of reducing its dependence on credit. But even with that, if you then look at the actual detail around the debtors book, despite the fact that there's less credit in TFG, the book is bigger. That's partly because the actual term loan, average term loan, is longer than in Truworths. It has a higher number of accounts with higher average values outstanding. Then Woolworths and Mr. Price are both around 16% credit. In Woolworths' case, the credit participation is higher in the clothing business and lower than that in the food business. And then Pepkor is 14% overall. That is a combination of about 17 or 18% in the Ackermans book, and then much lower number in the JD Group and the building materials businesses. Right, and then Shoprite Furniture, in that division, credit sales are just under 13%, but for the group as a whole, it obviously falls down to a very tiny amount and is just 0.5%. Right, if we now try and put some of this credit provided by the retailers into context of the entire market, so we look at these gross books in comparison to the 1.88 trillion outstanding consumer debt. In total, the retailers are 2%. And if we look at them then relative to their categories, so the credit facilities for the clothing retailers and the secured debt for the furniture retailers, it's about 13% and 2% respectively. So these are small players altogether, but nonetheless significant in our lives, of course. Just to look at some points to ponder when we're thinking about how susceptible they are to any changes in these legislation, is that the credit is obviously responsible for a much bigger proportion of retail sales than what the retailers fund themselves. So we know that at least some of the bank credit card debt finds its way into retail sales, and debt from other parties as well, whether it be loan sharks or less formal credit providers too. The other thing to think about is where retailers have white label cards. So both Pick n Pay and Massmart have private cards that are funded by RCS and run by RCS for them. Neither one of them discloses how big those cards are in their lives, but it does sound as though they are fairly small. And then the other thing to consider, particularly when we think about Lewis, which owns its own insurance company and it has been a significant contributor to profit, is whether this premium reduction process is over. The other two retailers that own their own insurance companies are Shoprite in its furniture division and Pepco. Bottom line is that it's very hard to tell from this amendment bill whether there's going to be a second round of reducing the credit life premiums or whether we're done. Time, I guess, will tell. And then just to have a look at whether these retailers are more or less conservative than your average South African credit provider. Our average acceptance rate of applications is 44% at the moment. It has been below 50% for about a year now. The clothing retailers are all substantially lower than that 44%. They're all in the 30% of those that disclose it. So Pepco doesn't disclose and Woolworths/Absa does not disclose. What is interesting in this is that Truworths, which is the business that is most dependent on credit, looks as though it is the most conservative. And then in the furniture side, Lewis has a very high, much higher than average, 63% acceptance rate. Of course, it is quite difficult to gauge what this looks like relative to its peer group in the furniture space. So just to start wrapping this all up now, I think we need to be careful and look beyond the obvious possible negative impacts of this bill. There is a moral hazard, but I think we need to be careful not to overstate that. There is a process to go through, and even if the debt is extinguished, that comes at the end of a 2-year process, unless the credit provider is found guilty of reckless lending. The retailers, as we have them now, have all got very substantial processes in place to make sure that the lending cannot be found to be reckless. The thing that does concern me more is that the boundaries of the bill are very, very fluid. They give the minister very sweeping powers to change the limits in terms of both monthly income and the value of the debt. And just to again flag to say, do be careful about just assuming that those consumers will have earned less than 7,500 Rand at the point of initiation of the contract. It is possible that they fall into the bucket as a result of some external event happening. Right, and then the last point, just to note from the Truworths result presentation last Friday, was that some of the clothing retailers are considering the legislation. This group does have a history of challenging amendments to the NCA and was successful in getting a rollback of some of the changes to process that were introduced in the 2014 amendments. Right, so just then to look at the companies themselves. Clearly, because Pick n Pay and Massmart have an element of dependence on the RCS book, they're not as defensive as you might think, although I don't want to overstate that at all. But the most defensive really are Clicks Group, Dis-Chem, and Spar. The credit retailers are all to a greater or lesser degree exposed here, but the one that is the most exposed looks as though it is Lewis, and that's as a result of a combination of quite a lot of different things. The first is that it is dependent on credit, with credit being 2/3 of sales in its traditional retail segment still. But more importantly, perhaps, is that the book is longer dated. So it's a 3-year book where the clothing retailers are between 6 months and a year. And it's much bigger baskets to start with, and your transaction value is far higher. It does look as though it's been a little bit more lenient than the other listed peers, but we don't know what its direct competitors are like. And the other point to note with Lewis is that its store base is slightly skewed to rural areas. And when you look at those flagged occupations in terms of farm workers and miners, it may be that their customer base is more exposed to those categories than other retailers. Monarch may be exposed to further reductions in the premium caps if we have a further step down in their leg as well. We've just had a situation where Lewis has posted its first earnings increase in 6 years, and that earnings increase only happened because of a provision release because of increased provisions from IFRS 9. So it is in the throes of having a proper squeeze on its profitability, partly because of this introduction of the premium caps 2 years ago. All right, just having a look. There's some more questions that have just popped up. Sorry, please bear with me while I figure out. Okay, so practically, how can this negatively impact consumer behavior? Sorry, I can't see the rest of the question. So practically, how can this negatively impact consumer behavior? I don't think it will negatively impact consumer behavior. It may impact consumer perception, that you think you have a free pass. In real life, you're going to have to go through a quite arduous process, and many people will find that they do not qualify for debt intervention, not just because so you could well have a situation where a consumer does in fact earn less than 7,500 Rand and has less than 50,000 Rand in debt, but they may not meet the definition of extreme indebtedness, and we don't yet know what that is. All right. All right, so that looks as though that's all the questions. Thank you so much for attending. I will be emailing you all a report once we finalize the comprehensive report. And if you've got any questions, please feel free to email me directly with them. Thank you again, and have a good afternoon.